Good afternoon and good morning, depending on where you're calling in from. Welcome to today's webinar. We're going to start right on time. It's 12 p.m. Eastern Time. I'd like to introduce myself. My name is Michael Mandarino. I've been a life insurance agent for over 23 years, West Point graduate and Army veteran. And today's topic, we're going to be talking about tax-free wealth and legacy planning for the ultra high net worth and high income earners. So as far as our agenda for today, I do want to discuss, obviously, the understanding of tax-free retirement. What does that look like? Also, we are going to be looking at multi-generational wealth strategies, individual case studies, diverse scenarios, and also key insights and charting your legacy. But before we get started, there are some disclosures. I'd like you to kind of read these. These are going to be based off of hypotheticals. So guarantees are not backed by financial strength or claims paying ability of any insurance carrier. This presentation is not endorsed or approved by Social Security Administration or any other government agencies. And again, these are hypotheticals. So we always want to make sure you are consulting a financial professional, and we do not offer tax or legal advice. So for those that are interested in wanting to reach out and discuss, there is a Q&A session that you can certainly answer any questions there in the Q&A section. And in the webinar chat, I will be posting how to get a hold of me with my email address. We're at 123-lifeinsurance.com, and my phone number is 813-807-0391. So moving forward. So again, thanks for everyone that's on the call today. So one of the top topics when it comes to life insurance, what if we can increase your capital while lowering your overall household risk? So some ideas we're going to talk about when you're looking at life insurance, two things. One is we're going to change the mindset. Most individuals look at what's the biggest death benefit I get for the least amount of insurance and for the least amount of costs. So we're going to say, let's flip the script. What is the lowest amount of death benefit with the highest premium going in there? So what we're talking about is reaching the IRS limits of what the IRS allows us to reach when it comes to purchasing a life insurance policy. We're going to show you some of those wealth saving strategies. So when it comes to life insurance, I teach my clients that you may not love life insurance and you might even hate it as an option, but you have to also know it is a platform that, if used correctly, can be a great way to use it for leverage and to build generational wealth. So for those, I know we have a lot of entrepreneurs and business owners. I'm sure you hate paying taxes. You hate paying a cost of running a business. That's kind of the same thing when we're looking at using the structure of life insurance is, yeah, there are definitely fees inside the policy, but to do that, that's where we're able to get the tax advantages that come with that. So, when we're looking at a household portfolio, obviously these are just the basic stocks, bonds. We like to say there is a portion of that should be in tax advantage life insurance. So those are things we're going to discuss. And for those that have never learned about life insurance, what we're going to talk about today is one of them is going to be index universal life. So why index universal life? Well, with index universal life, it does come with an interest crediting method. So this is an example of what the stock market's going to look like for any year. So the market's going to go up, it's going to go down, it's going to fluctuate. With an index universal life, there's always a cap. So you can see there that the piggy bank can only go as high as that cap rate is, and that changes with every insurance carrier. So in this example, even though the market continued further, that cap was locked in, and that's called an interest crediting potential rate of the cap. Now, one of the main advantages of that is the floor. So opposite of the cap, the floor, of course, is on the high end. The cap is on the high end. The floor is on the low end. What that means is if the stock market or the index crediting strategy goes below zero, you just don't earn any interest. So there's no interest that's credited to the account that particular year. So in this case, you can see there's those negative numbers. However, you're going to start the year off flat. And that's really when we start looking at those markets, when the markets go down, and this is, of course, the up years and the down years. Typically after a down year, the market's almost always going to go up. Well, it only goes up if you have the cash available to invest. So what is the main difference. So historically, the markets have returned 9.82% dividends. Without dividends, you're talking about a 5.89%. So, when we're looking at historically, what does that mean having a 0% floor? So with that 0% floor, it actually, if we can eliminate all the market declines, that means your stock market investment would have done 12.32%. But with Index Universal Life, we did talk about there's a capture rate, that we were capped on the upside. Well, we've done some statistics and the studies available that in the last 10 upside years, 82% was actually was the actual cap. And then out of all years, 87 of the market upturn was all captured inside with the index crediting method being a cap. So what does that do for overall returns? That hypo example, we're just going to use a basic 80%. So if we went back to those same returns in the stock market, we're able to get a 9.8% return potentially with dividends. And that's not showing, again, taking out all those negatives. So what's nice about an indexed universal life product is it always moves forward. And any negative year, you just don't earn interest as credit on those. So again, these are just some basics I want to talk. Well, let's get into the meat of why folks are really coming here. So when we're talking about tax-free retirement, we're looking at premium funds are paid by the client. And this is for those CPAs that are on here, based off the IRS section 7702, your life insurance allows the ability of it to accumulate tax deferred and then also potentially linked to an index or a market. What this is really where you can really do very, very well with these types of policies is the tax-free access, which is section 72E of the IRS code, which allows you to access the capital inside your policy on a tax-free basis. So when you take money out, it's not reportable to the IRS. You don't have to declare it when you're doing your 1040. And it's not required to be repaid. So that's really the interesting thing that we're kind of going to focus on there. So, and then ultimately section 101A, the life insurance death benefits do go to your beneficiaries tax-free. And of course, there is a reason most people get life insurance as a death benefit. We also are going to look at the different living benefits. And also with our policies we work with, it does also help with long-term care. Statistically, 70-80% of Americans are going to have some type of long-term care exposure, whether it's even for a short 90 days or even longer term. So that could be another way of protecting your assets from, creditors and so forth. Now, this part is life insurance policy loans, how your money can grow in two different places. So what happens with the loan is, Warren Buffett says, I'm buying when everyone else is selling. However, if you're in an S&P 500 investment, the market goes up and the market crashes, so does your investment. Your investment crashes. Well, with the Index Universal Life or other life insurance cash value strategies, we would say, you can borrow the money. The insurance companies use your death benefit as leverage, and then there is a policy loan. So when you take that money, you can obviously, when the market drops, you can borrow from yourself using the leverage, and you can purchase whether it's real estate, whether it's stocks, mutual funds, and you can make those payments back at your own schedule. So you are in charge of when you make those payments back if you decide not to do that. So what we're really showing is really creates a very, very unique arbitrage opportunity. So life insurance loans, so obviously inside the policy, you have the cash value that continues to earn dividend credit. So that's the key factor. When you take out a policy loan from your account, your account value will still grow, but there's also a loan balance that will also grow as well. So that's what we're talking about. If we can get even a 0.5% arbitrage where you're making money off of your money that you've already borrowed out. And of course, outside of it, you're using it as leverage. You're using it for your investments. You're buying real estate, maybe expanding your business. If you're a business owner, you may need to use it to pay for payroll 1 month. So really unique opportunities of how you can use your life insurance policy. And then you decide how you pay back those policy loans. All right, so we're going to go through a bunch of case studies. This is going to be the first one. We're looking at a 45-year-old male. So this is going to be multiple options. So that 45-year-old male has a goal of retirement at age 60. He's in good health. In fact, we're talking, in this case, preferred rates. His goal to have tax-free retirement starting either 60 or 65. This individual has $75,000 to invest annually for 15 years. So we're looking at about just a little over $1 million, 1.125 million is invested. And with this case study, again, it is a hypothetical. Everything is different. So based off of your age, that's obviously going to change things. But initially, just to show you, what does that self-funded investment look like? So again, we talked about 75,000 initially, providing a $3.15 million tax-free death benefit. At age 60 to 90, again, this is potential. We have to have market returns. In fact, in this case, we're making an assumed rate of return of 6.58%. And then we're also showing that there's a policy loan rate of 5.7. So we're actually borrowing out $148,000 a year from age 60 to 90. And of course, we're doing that. So total up to age 90, we're looking at putting in that little over 1.1 million, but we're taking out $4.61 million. And the key to life insurance is, according to the IRS, as long as a death benefit pays, then all the money that's earned in that policy goes tax-free to the estate. So in this case, if he lives till 90, there's still a $1.92 million death benefit tax-free that goes to their beneficiaries. So looking at that same self-funded individual, 45-year-old, we're looking at if he starts at retirement at 65. Now we're talking about being able to get him $200,000 of tax-free income, which is equivalent to about $5.2 million if he lives until 90. There's always a death benefit if he passes away earlier. And again, this death benefit is still $1.5 million. So we've put in the same amount, a little about 1.125 million. We were able to take out 5.2 million plus another $1.5 million death benefit. So almost $7 million. So generic math, we were able to bring out $6 million with no capital gains. And again, that's all based off of the IRS code. These are things I'd love to be able to build these types of strategies for you and show you, does this work for your particular situation? Now, this same individual has, when you're looking at the key milestones for that case study number 1, at age 50, has $355,000 available for a policy loan. There's also $760,000 and also $1.5 million. So there's still loans that are available along the way that he can borrow from, put in other investments, and pay himself back, especially if there's a major downturn in the stock market. Now, that same case study, we're going to look at a hybrid funding model. So that same 45-year-old male, he doesn't have the full time frame to contribute. He only has 5 years to put his own assets in. This is what we call a hybrid funding model. So out of pocket, he has $380,000 to invest for the first 5 years. We're also getting, if you can see here, lender contributions. So we're actually using the policy loan as collateral. So now we're getting about $55,000 for the first 5 years. And then from year 6 to 10, this individual does not invest. So for folks who may feel they're behind the power curve in their retirement, this is a great solution, especially for the small business owners, that can potentially, and the minimum amount for this is $22,000 a year that you have to commit. And you can see here, when you're committing that, the lender then commits the next 5 years. So totals of 10-year funding the policy. So we're looking at borrowing $926,000 and combined contributions $1.3 million. So what happens here is that we're going to let that loan continue to grow along with the cash value in that account. And typically at year 15 is when we're going to borrow that money out. In this case, we're showing it borrowing out at age 65. So, it has a smaller death benefit, 2.16 million. Tax-free income from 65 to 90 is 3.25 million. So the good thing is, again, they're putting in a lot less money than the first option, which is putting that $76,000 for a total of 15 years. And there is also still a tax-free death benefit of $1.43 million at age 90. So the advantage of this one is less out of pocket. Not everyone qualifies for that. There are certain minimums of how much income you have to make. Typically, you have to make 150,000 or more. And I know most people on this call, when you registered, you're most likely beyond that. Well, as far as the income, so that shouldn't be an issue. Disadvantage: you don't have the same access to the policy loans like you did in example number one. So you don't really have access to any capital for the first 15 years. So again, this is that young individual, whether it's 45 or 50, it works out really good where they have 15 years to just save for their retirement, but they don't have the access of maybe working for those full 15 years. And they only really want to kind of front load it in the first 5. And also there's interest rate risk. We don't know where interest rates are going to go at. So these are all the hypotheticals. We go over all the risk when we build your policy. So, feel free to, again, for those who are just joining, you can see my schedule and my phone number and email, how to get in contact with me afterwards. Now, continuing on case study number 1, this is an opportunity that is only available for folks who have a net worth of at least 7 million or higher, and we're doing fully premium financed. So we're using the same thing. We're using the policy as leverage, and most likely we're going to probably have to come out of pocket for another $100,000 or $150,000 of additional leverage until the policy starts accumulating some assets. So you can kind of see here, we kind of built up the same amount, was average annual payments of $700 or $75,000. We wanted to kind of keep it pretty close to this first scenario. The only thing this 45-year-old male is required to pay is the interest payments. And you can kind of see the average amount of interest payments. So obviously interest payments get larger the more the policy gets. Same principle, we're going to wait and pay off the policy loan is repaid in the 15th policy year. We did make some assumptions of 6.55% index crediting and an interest rate loan of 5.7%. So that 45-year-old male, $2.99 million initial death benefit. Now that is the big thing that's very, very different. $282,000 potential lifetime income from age 60 to 90, which is 8.4%. So, or $8.4 million, excuse me. And then there's still a $10 million tax-free death benefit. Again, you may ask, how does this happen? The big thing is it's that leverage. When you borrow from this account, your account value is still growing, like the money is still in there because you're using your policy and death benefit as leverage. That's how we're able to accumulate that. So when we look at the advantage of this one is, less out of pocket earlier years, uses the leverage potential to build greater wealth and potentially greater results, higher death benefit and income streams that are provided. Disadvantage, again, no access to the capital for 15 years. There is interest rate risk on the loans. If interest rates end up skyrocketing, which we've seen, over the last 2 or 3 years, that could be a problem. So again, those are all risks that we would definitely discuss and look at it. And again, typically most of the carriers, at a minimum, you'd have to have 5 to 7 million. I've seen 5 million be the lowest with some carriers, but typically we're talking about 7 million, even 10 million and higher. So looking at the capstone of those 3, I know this, maybe a little bit hard, but self-funded, initial death benefit, 3.1 million, $148,000 a year. The hybrid model was, and they're only looking at paying 380,000 versus 1.1 million out of pocket. And initial death benefit, 2.1 million. So definitely a lower death benefit, and also lower payments. So $130,000 versus 148. And then for those that qualify for the premium financed, payments of 1.33, so a little higher than both of those. Obviously, $1 million more than the hybrid model. But the key factor here is the amount that they're borrowing out after they pay back the loan is $282,000. So when they have that large loan payment of when they're paying that back, that money's still growing like it's never been taken out. So even though it was a big policy loan, the account value potentially is still growing based off the interest crediting method that we choose. And that still shows a the big factor here is there's still a $10 million death benefit that's available for the family, a state, or even a church or charity. So let's look. Next one is going to be a case study for a 44-year-old female. Her goal is to retirement at 60. She's in great health. She has again, I'm showing different examples of how we can build this. So there's not one size fits all. When we work with our clients, we try to understand what is your goal. And then we try to then backstep, how do we want to reach this goal? In this case, she wants to retire by the time she's 60. She has $1 million to put in currently right now. And then she has another $50,000 a year for the next 3 to 17 years. So we're putting in 1.7 million from 44, and she plans to stop working at 60. Initial death benefit, 5.2 million. Tax-free income, 351,000. Total income, $10 million of income that we were able to generate from the amount of money that she's putting in there. And there's still a tax-free death benefit after she's taken out all that income, $351,000 a year. We're able to, end up being a little over almost $4.3 million. Again, that's a hypothetical. The markets have to have performance, and that's also assuming a 6.63% index crediting method. So I know there's a lot that we're teaching here. When I sit down with you, I want to make sure our clients fully understand all the methods that we're going to be talking about. Our next study is, we're looking at a case study. Was that we had a 50-year-old male, had a goal of retiring in 15 years. He was in good health, wants tax-free retirement, has $1 million lump sum, or looking at $5 million lump sum. That was the decision, what we're trying to do, and that was going to be in the first year. So with insurance, we have to spread that money out, so it does keep the tax favors, and that's something our planning teams will do for these individuals. So in this case, the first option is $1 million lump sum would provide an immediate 2.7. So we're 2.7 times the amount of money that's there that would go to his beneficiaries. We create an income stream of $211,000 from age 65 to 100. So hopefully bridging the gap of what they need, what he needs at retirement. Total tax-free income is $7.4 million. And there's still a $1.6 million tax-free death benefit that goes to his or her beneficiaries. Again, these are hypotheticals, but this would be an example of different ways of structuring it. Whether you do a $1 million lump sum, the next one we're saying, okay, well, he has $5 million a lump sum. So, might be happy with his market returns, might want to sell to some stock and kind of worried where the stock market's going to be at. So this would provide an initial $13 million death benefit. However, based off of a 6.63% index crediting method, which again has the cap and the floor never has a negative year, we're able to generate $1.1 million of tax-free income, which is projected about $37 million during his lifetime. Again, making the assumption that he lives until 100. And then there's still a tax-free death benefit at age 90 of $7.6 million. So the death benefit does fluctuate when the loans are taken out. So depending on the year, that could be higher or lower. So doing this comparison, we had the number 3, the 50-year-old male option, $1 million versus $5 million. Obviously, the more money you can put in, we're talking death benefit of 2.6 versus 13 million, $210,000 a year versus $1 million a year. Total projected income, 7.3 million versus $37 million of projected income. And then of course the difference would be, the taxes. So again, if you're in that situation, let's take a look at it. We also got to make sure you're insurable. We look at multiple carriers of what's going to be the best situation for our clients. So that is an advantage when you work with our team at 123 Life Insurance is we are independent. We do have some carriers we like to work with based off of how their rates compare, but we also can shop the marketplace, especially for those that might have some issues with getting insurance. Our case study number 4, we have a 60-year-old male, has 10 years to retirement. He's in good health. In fact, we're using preferred rates here. Wants to start taking income at 70, has $5 million a year for the next 7 years to be able to invest. So we're investing $35 million over that time period. And again, this is part of his portfolio. Well, initially that would self-funded would be worth $63 million of death benefit. We're looking at income per year starting at 70 to 100 of $4.3 million. And we're still giving a death benefit at age 90 of $24 million. Again, it is a hypothetical. Stock markets still have to have performance. But again, the good thing is by having that floor in place, there's never a negative year. So again, we're hoping that we're going to be able to get market returns with the safety of not having that downturn in the market. So total income over that time period, $129 million. Still providing a $24 million death benefit at age 90. So our next is looking at multi-generational planning. So, again, with the IRS section 101A, death benefit is tax-free. Current exclusion taxes for 2025 is, almost 14 million per person. So 27.98 million for married couples. And that maxes out 40% with over $1 million limit. So, that once you're over that million, the taxes are very, very steep at that point. And then 2026 total is $30 million. And again, anything that maxes out $1 million over the limit is going to be, taxed at least 40%, if not higher, depending on the state that you're going to be taxed as well. So in this particular case, we're going to look at is the multi-general, we're going to use the exclusion tax. So we're going to take advantage of the $19,000 that you're allowed to give per recipient. And we're going to be using that to the advantage of this couple for multi-planning. So we have a 60-year-old male and a 59-year-old married female. We're going to create an ILIT, which is an irrevocable life insurance trust. Their net worth is $55 million. So their potential is they're looking at least 40% estate tax on all assets, over that next year. So 40% of $25 million is what they're going to be potentially exposed to. So that is, what their issues were. So looking at how do we protect those assets from creditors? Well, that irrevocable life insurance trust, what we did was we contributed 13 million. So we took one lifetime part of their exclusion that they're able to give, and we contributed that 2.7 million for 5 years. So almost the entire exclusion. And we create a guaranteed tax-free $35 million death benefit that is excluded from their estate. So that is out. They can list any beneficiary. That's not going to be part of any estate taxes. So we were able to help reposition a lot of their assets so they're not going to be hit with that huge tax bill upon death of the second spouse. In this example, we have another strategy is we have a 61-year-old male and a 56-year-old female. They have 2 adult children in their 30s. Their net worth is approximately 20 million. Again, they're young. By the time they retire, that 20 million could be worth 30 million, could be worth 40 million. It still has the potential of growing. So there is still a potential estate tax issue that they're going to be dealing with. So in this case, we went ahead and we ended up buying the insurance on the 56-year-old female who was the wife, and the mom was in better health. So we look at contributing $19,000 per child. So a total of $76,000. So you have the couple. So we are taking that same amount of exclusion that they're allowed, and we bought a tax-free death benefit of $6.8 million on mom. So again, these are just some strategies if you're dealing with that situation of not wanting to pay taxes. And again, that's not guaranteed. So there's been a lot of times where the estate taxes, when I got into the industry, it was only $500,000, that everything over $500K was going to be taxed at 40 or 50%. So those are all things to start really thinking about. And the younger you start thinking about it, the better off. Again, that irrevocable life insurance trust, our team can help get that set up. And this money is going to be excluded from the estate. So that legacy planning, another option we have is that we have a 65 and a 62-year-old married couple. They have 4 adult children, ages 32, 35, 38, and 40. Their goal is to leave a legacy for their 8 grandchildren. They have $1 million to contribute. So their option was, hey, we're going to, initially they had this CD that they were just going to let that CD accumulate and give to their grandkids. But instead, we looked at the option of buying life insurance on all 4 of their adult kids. They all vary in health classes. So in this example, we looked at one option would be option 1 is taking that $1 million to purchase life insurance on the 65-year-old. We invested over a 5-year period. The beneficiaries are the grandkids. So with that scenario, that $1 million off the 65-year-old would get them approximately a $2 million tax-free guaranteed death benefit. It does potentially grow at age 90 to $3.6 million. So that's the first option. But if the kids are insurable, let's look at option 2. So option 2 is we're buying a combination, initially insurance on $250K exactly across the board. We have the 40-year-old female. She was in preferred health. You can see here 38 preferred health. 32-year-old is a smoker, but in good health. And then the 35-year-old female is a standard health. So looking at that, initially we're getting a $2.3 million tax-free death benefit. But because of their ages and how long they live, hypothetically, if each of those kids passed away at age 70, they all exactly on their 70th birthday as an example, then that's $9.9 million from those initial death benefits are going to go to the kids. And of course, that changes out to 80 is $15 million, tax-free. At 85, $19 million. Again, this is a hypothetical. This is, in this case, we're showing, yeah, each adult child dies exactly on their 80th birthday. Again, but you can kind of get the idea of how if you use leverage of the longevity of their lives, how these policies can continually grow over time. And also, looking at almost a $25 million tax-free death benefit. In this particular case, we would list all their grandkids on each one of the aunts and uncles and their parents' policies. Again, my goal is to really kind of teach you some outside of the box thinking when it comes to how do we pass money to the next generation and generations to come? How do we build a legacy? So that comparison, going back to we had the ILIT for the 6-year-old male. They funded it at almost $14 million for 5 years. So we looked at that exclusion, created tax-free of $35 million. We had the 56-year-old female was gifting $76,000 a year into that irrevocable life insurance trust. We created a $6.8 million tax-free ILIT death benefit. We had the 65-year-old male funding over 5 years, a total of $1 million. That equaled $3.6 million at age 90. And then we had the legacy ensuring the kids that all 4 of those policies, $250,000 each, would create a $25 million death benefit at age 90. Again, that's combined. That's not realistic that they would all live exactly to 90, but hypothetically, we just wanted to kind of show those ideas. So some of our key takeaways. The big thing that when it comes to life insurance is I teach my clients to how to use their policies with leverage, how to use the tax-free loans, how to borrow against it, especially in a down market, or if you're into buying real estate or investing in your own company. However you use a loan, it doesn't matter. It's your money to borrow against it. We have a robust option of using life insurance for estate planning purposes, using the ILIT structures. The triple tax advantage, benefit of tax-deferred cash value growth, tax-free access to funds via the loan, and the income tax-free death benefit for the beneficiaries, and also creating that long-term income stream. Specific applications, every high net worth client is in a different situation. We're just trying to also think not only for today, but think about the next 10, 15, 20 years of the growth of your portfolio and to see how do we maximize retirement income that's tax-free, and also how do we maximize, building that legacy for the long-term options as well. So what are your next steps? So obviously when we get together, again, I'm going to post my schedule. My phone number there is for those that are listening only, 813-807-0391. to schedule a call with me or my team. We will be sending up follow-up emails for the next 3 to 5, 6, 8 weeks to come. So if you don't want those emails, just let us know. We don't want to spam your inbox, but we want to make sure that you're getting and making the best decisions. Once we do your financial assessment, we'll determine what kind of option and investment portfolio we want to be looking at for you when it comes to the insurance. We would do a health evaluation, determine where you're at. If there's potential for being a low at-risk client, then we can shop the market. We work with multiple carriers where we kind of let them know, hey, we're trying to get a $5 million tax-free death benefit policy. We have a person has diabetes, potentially was a cancer survivor. We can work with our different individuals, and then they'll bid on it to see who comes back with the best rates. And those are soft hits, so we actually don't put a mark on your medical information bureau. And of course, the strategic strategy. What do you want to do? Are you looking for tax-free growth? Are you looking for a hybrid model? Does premium financing make sense? Those are all things that I love to be able to just kind of assist and talk to you about, and help you. And again, ultimately is implementing and funding. So once our team goes through it, once the underwriter comes back, once we know what you're approved for, then we come back and say, okay, now this is what you're approved for. Do you want to take the whole policy? Do you want to get more insurance, less insurance? What type of funding methods are going to be? And most of our funding, it is very flexible. Whether you're funding it on an individual basis, on a monthly basis, yearly basis, a lot of these policies can come with the flexibility of how you do that. So, at this time, I'd like to pause there for any questions. I don't see any questions currently right now in the Q&A. So for those, you should be able to see a Q&A section as far as anything that could be there. As far as if you have any questions, I'd love to be able to answer those right now. I'd love to be able to review your existing wealth and legacy plans. So if you already have an insurance policy, and if you have an insurance policy that you don't want to keep anymore, we also, depending on if you're insurable or not, or if you're not insurable, but your policy is starting to cost too much, we have potential carriers, if the case is big enough, that actually will purchase that policy back from you. Again, my name is Michael Mandarino. You can reach me at 813-807-0391. You will start getting emails from us. Also, we'll be sending out a recording of this webinar. Please feel free to share with anyone that you think would want to see this. I'd love to be able to help you out. I'd love to be able to, be on your team. I work very well with, your financial planning team or your CPA team that you're already working with. If you're a company and business owner, we can also talk about creating buy-sell strategies for you, a key man insurance policy. We also have cash balance plans that we can work with as well on the investment insurance side for you. So thank you for your time today. I'm going to go ahead and include and stop right now if there's not any other questions. Again, thank you so much for your time. God bless you all and have a blessed rest of your day. And I'm going to stay on. I'm going to pause the recording, but I will stay on for those that potentially have any questions.